The Commerce Department reported today that groundbreaking on new homes reached its highest point in September since July of 2008. So that's another big indicator that this recovery hopefully has some legs to run with. So Mike's got a lot of information to present tonight. So several months ago, Mike came into this room and met with the staff of Wealth Trust Arizona. The room looks a lot different when we're not doing these events. But he came in to give us some insight on what's going on here locally from a real estate perspective. Many of our clients have real estate in their portfolio, but their primary residence is a significant part of their overall net worth. So the insight he was giving us, we couldn't normally get from just anybody, especially here at the local level. Mike is the premier authority on the topic. And we were so impressed with the information that he shared that we decided that in the fall, when all of our clients were back from their summer vacation, we wanted to present him to the audience and host the event here so he could share with you the same information he did with us. By now, hopefully you've had a chance to read the bio on Mike. We've sent it out in the past. It's on your chair. He has his degree he has a degree in mathematics from the University of Oxford. Spent a lot of time in the computer industry, 31 years in fact. Spent a lot of that time in California before relocating to Arizona. Since 2002, 2005, you've been up and running now, creating this vast database. So today, if you are driving home from work and on KTAR or KFYI, or you read the Arizona Republic in the morning, whenever they quote local Arizona statistics, they're usually quoting Mike Orr. So tonight we have the foremost authority here locally on the subject. He asked for a short introduction. I hope that is short enough. For the sake of the presentation, I'm going to turn off this light here so you can see a little better. Thank you, Mike.
Thank you so much, and thanks for coming to hear me. Very impressed with being provided with a chair. Yeah. So you can tell from the introduction that I've been around a bit, but I'm relatively new to real estate. I've only been doing it for about 10 years, but I'm a mathematician and a computer guy. So I set up to see what I could discover by applying everything I knew about computers, databases, etc. And I quickly learned that the data in real estate is incredibly inaccurate. And I spend probably a third of all the time I spend cleaning it up to try and get into a form that you can actually use effectively. Unlike data on the stock market and other things where people are actually double checking and computers are balancing everything, real estate is generally done by hand and nobody checks whether what you put is actually correct or not at any stage of the process. So that's it's kind of a challenge for me to actually make mathematical sense out of all this stuff that's so messy. And it can be done. One of the things I like about the real estate market is actually it's easy to tell what's happening and forecast at least a little bit into the future. Whereas in most other markets, you can't even forecast what's going to happen in the afternoon from the morning. But the real estate is a very slow-moving market where transactions take a month or two. So it's been very rewarding. I've discovered a lot of things. One day things will get quiet enough that I'll actually be able to write a book about it. But right now, everything I find out, I immediately publish on websites and talk about to the press. So please feel free to interrupt and challenge anything. I'm happy to make this very conversational. What I'm going to do is show you some mathematical data in charts and things like that. But I'm going to start off with some textual statements. So this is really kind of a summary of what the market is at the moment. I'm going to finish with another textual chart which tells you what I see going forward. But some of these things may surprise you. Maybe not, but there's a lot of people who believe things about the real estate market that aren't really true. First of all, how many people have come across the phrase shadow inventory? Just about everybody? I mean, that's been hawked around for about 4 years. It sounds really scary. People use it as a reason for not doing anything because shadow inventory is going to come out and bite your butt if you actually do anything. It's not that it's not in existence, it's just that in Arizona, it's not particularly important and it's not going to affect the market. I'm going to explain why later on in the presentation. It is important in some parts of the country, so what I say is specifically about the Phoenix market. And we're different because we have different legal processes here than they do in other states. Every state is very different. But don't waste any time worrying about shadow inventory would be my advice. It's a little bit like the Y2K problem. Remember when that was going to make all the stock markets go down by 50% around the world, and your toaster was going to rise up and kill you? I mean, when it came to it, nobody noticed. Maybe one or two small businesses somewhere had a minor problem. Shadow inventory is a bit like that. It's not that it's not real, it's just it's gradually disappearing, and it's not going to suddenly arrive in one great lump. At least not here.
Can you define it, please?
Well, that's really difficult because everybody who uses the phrase has a slightly different definition. But I'll give you the most common one. There's actually multiple categories, and I'm going to look at each one. The first one is homes that have been foreclosed and the bank owns, but they haven't listed for sale yet. Some people believe there's an enormous number of those. There aren't. That's probably the least significant supply. Because banks do not like owning homes. They try and get rid of them. Then you've got homes that are in foreclosure, but not actually being foreclosed yet. So somebody's had a notice, but it's not been resolved. So something's going to happen to that home. There's going to be an auction, or they have to do something else, either catch up, modify their loan, do a short sale, or something. So that is, both of those are valid valid shadow inventory categories. Most people don't count those, though. I mean, I'm in the unfortunate position where I actually have to count those and work out whether they're important or not. Then you have a slightly more nebulous area where people are behind on their payments, but they're not in foreclosure. Maybe they're only 60 days behind. Maybe they're 128 days behind that the bank hasn't got round to issuing them a notice yet. And that's where it's much more difficult for me to actually prove stuff, because that is confidential data, it's not public records. I would have to go and pay the credit reporting agencies like $10 per person to collect that data, and the ASU doesn't have that sort of money. So I rely on information that I get, which is collected at a higher level about the state as a whole, and I'll show you some of that. There are some people who will define shadow inventory as only those who are seriously delinquent, which is, again, a moving target. Most people will take 90 days late as seriously delinquent, but you could argue that it's 60 days. Some people will include everybody who's underwater. But in a state like ours, with prices having gone down to 58%, that's rather ungenerous, because there's an awful lot of people I know who are underwater, but there's no way they plan to move, they can afford their mortgage, they're not really about to list their home unless there's some major change in their life. The kids leave home, or they get divorced, or something like that. That's the sort of thing that makes people put houses on the market, not the fact that they're underwater. There were some people who did strategic defaults. Most of that's been through the system already. But I hope that helps. There are so many different definitions, though, that I've never found two people to agree exactly on what it is. Now I'm going to go through some good news. First of all, delinquent home loans are down 49% from the peak. That's a big drop, and it's the biggest of any state in the country. So, as Arizona residents, we can be proud that we're less delinquent than we were. Yes?
What do you consider the peak?
The peak was actually around January to March 2010. And again, I'm going to show you some charts on this, so that will probably answer some of these questions. But we've had a big drop in that period, and bigger than any other state. We've also got a big reduction in pending foreclosures. I think that's probably the best way of measuring how much distress we've got, measuring how many people are actually under foreclosure. Remember, that's one of the elements of shadow inventory. We've lost 73% from the peak, which was a little earlier than what I just said, but only by a few months. End of 2009, beginning of 2010. And one of the other elements of shadow inventory is anything owned by lenders. People call them banks, but actually half of them are owned by the government, Fannie Mae or HUD. I count that inventory. If you're interested, I can send you a spreadsheet with every single home listed, but of course it changes from day to day. They get new homes foreclosed and they sell some of them off, so it's a new spreadsheet every day. If they all came onto the market all at once, it represents only 18 days of supply, so it's not really very disruptive. In fact, with supply being fairly short in the real estate market at the moment, there'd probably be a big cheer if all of these homes came on the market, because buyers are actually not finding very much to choose from, at least at the bottom end of the market. We have a shortage of homes for sale below the median sales price, which is currently about $150,000. Now I know that doesn't get you very much around here, but it's for the greater Phoenix area, that's half of the homes sell for $150,000 or less. That's a big part of the market. and they are extremely hard to find. One of the effects of having a shortage is, as in Economics 101, we have a supply problem, so prices go up until more and more sellers come on and actually balance things out. Surprisingly, it's gone up by 28% in measured as dollars per square foot, but the majority of that is improvements at the bottom end, not at the top end. In fact, the cheaper the place is, the more the prices have increased in the last 12 months. And in fact, the record is held by a zip code 85009. Anybody know where that is? Probably not, because unless you make a habit of visiting Lower Buckeye Jail, you probably don't go to that part of town. But it's the surrounding area. That at one point, homes there were selling for $150 a square foot at fee. At the bottom, they were $21 a square foot, which is a loss of 86%. So if you're worried about the fact that your house went down by 50%, imagine what it was like if you were an owner there. And they have actually increased by 120% in the last 12 months, there, from $21 to over $50. So if you get the timing right, people can actually make quite a lot of money. Obviously, this house is not something you can trade willy-nilly because the transaction costs are very expensive in housing. Another piece of good news is that new home sales are up. They are up from a very low level, however. 55% is a big percentage, but it's only a small absolute number because we were building so few this time last year. And that's an annual comparison. I'm going to come back to that at the end of the presentation. We are now supply constrained in new homes. Last year, builders were giving all sorts of incentives to people to buy homes. Now, if you go and say you want to buy a house, they'll check and say, I'm sorry, we've sold the only 2 we're allowed to sell this week. You'll have to come back next week. Because they are restricting the numbers they will sell because they don't want to run out. And they are in danger of running out. In particular, they can't build many, many more because we have this really ridiculous thing of having a shortage of skilled workers, which is kind of hard to believe when we have an unemployment problem, which we do have. But the people who are unemployed don't have the skills that are needed for construction. In fact, most of the people who have the skills in construction were undocumented. So they've gone, and they ain't coming back. Because anyone who hired them now would lose their license. So we relied extremely heavily in the house building industry on undocumented workers back in 2005 and 6, possibly as many as 60 or 70% of the people. But we lost 100,000 jobs in construction. We've so far got about 5,000 back, but we could probably employ another 20,000 pretty quickly. And unfortunately, these are the people who do the subcontracting here finding it very hard to attract people into the industry, even though the wages are going up quite fast. I'm talking about plumbers, painters, roofers, framers, drywalling, all those things. Each one has its own specialist trade. And what they're doing at the moment is each firm is saying, okay, let's raise our wages by 10% and try and attract all the people who work for our rivals. It doesn't increase the number of people who can do that, it just moves them around. So it's not making much progress. So let's look at some of these things. First of all, the delinquency rate. We were in pretty bad shape back at the beginning of 2010. 16.3% of our loans were at least 30 days late. This is according to Lender Processing Services, which is one of the bigger companies that handles loans and produces a report every month, which gives you the figures for each state. At that time, we were 5th worst in the nation. We're now 38th. We're down to 8.2%, which may still sound a lot, but remember this is including anyone who's only 30 days late, and quite a lot of people get 30 days late and then catch up by the time they get to the 60 days. And the normal level is about 5%. So we've come well over halfway down back to normal, and we're still headed down. The next one we're due to overtake is Utah and Oregon, who are both just a shade below us at the moment. USA as a whole, however, has only improved a little bit from 13.5 to 11.1. Clearly, some people are not doing as well. Another way of looking at it is who's worse. Florida is by far the worst state for delinquency. It has been #1 for the whole period, and there is still more than 20%, more than 1 in 5 of their loans are delinquent. North Dakota has been best throughout as well, because of the energy jobs there. They've really got a low delinquency rate, but even there, it's 3.89%. So we're headed down to the low level, which is good news. It's not so good news for New Jersey or New York and some other states I could put up here too. They're actually in worse position now than they were at the beginning of this period. And there's a legal reason for this. In New Jersey and New York and in about 20 other states, it's necessary to go to court to get the foreclosure to happen. Here, when you sign a deed of trust, you already give to a trustee the right to sell your house if you don't make your payments. So there's no judge has to decide whether it's correct or not. It's just a matter of process. If you're late and default, the bank has to give you a notice of trustee sale, and then 91 days later, the trustee can sell your home away from underneath you, with no real mechanism to challenge it. If you're in one of the judicial states, then the bank has to go to court, basically sue you for not paying, and try and get the judge to decree that the sheriff should sell your house. That can take 3 years instead of 91 days. And that's even if lawyers don't get involved. Do we have lots of lawyers here today? No? Well, lawyers in some of these states, particularly Florida, where this applies, they have made a business out of keeping people in their homes without paying their mortgage. Because you can imagine a creative lawyer can come up with all sorts of ways in which the lender has not quite documented everything right. And the lender has made it really easy by doing things like forging signatures. So we've got lots and lots of ways in which people can stay in their homes for 3, 4, 5 years free of charge, not paying their mortgage but not being thrown out either. Now you will find a few examples of that in Arizona, but they're much rarer, and the vast majority of people who don't pay their mortgage find that they're out of that house within about 6 or 7 months typically. This is actually showing you where things are good and bad right now. This changes every month. The latest numbers are for August. There's obviously an exception in the West, which is Nevada, where things are still much worse, but most of the west of the country is actually having significantly improved delinquency rates. The problems are mainly down here and up here. And we are now actually better than California and better than New Mexico. We used to be almost as bad as Nevada at one point.
How come the difference between Nevada and us? I thought we were real similar.
No, we used to be actually, but
yeah.
Nevada has, they had even more speculative buying of homes before we did. In fact, at one stage, we had a flood of people from Las Vegas here trying to do here what they had already done in Las Vegas. They're a much less diversified economy, so that they've got higher unemployment than we have. And also, unfortunately, the state legislature has kind of interfered with the foreclosure rules and made it harder to foreclose, which has caused more and more loans to get backlogged and unresolved. So their delinquency rate is not dropping as fast as ours is now. But they've been pretty much in bad shape, and for quite a long time, second only to Florida. They're dropping a little bit as New Jersey and Mississippi have started to overtake them, but they're still in the top 5. Another thing that is clearly true if you study the numbers, but I still get people challenging me. Only yesterday I was at the City of Phoenix meeting and people were standing up saying, foreclosures are still going up. People don't necessarily count the numbers like I do, but they are coming down, and here's one way of proving it. This is a monthly count of the number of homes in Pinal and Maricopa County that are under foreclosure. A normal level, because we always have foreclosures, even in the best of times, was around 6,000 at that point. We've got more population now, so something like 7,000 or 8,000 would be typical now. We actually went lower than that during the peak of the housing bubble and reached 60,000 at the worst point. We're now down to about 15,000. And as you can see, it's dropping. We had a bit of a leveling off here, but it's now dropping, and we're not that far away from normal. So this is one reason we've got a shortage of supply. All of the homes that used to get foreclosed in this period and keep flooding the market are no longer flooding the market. So we've got a lot of investors in town who would wish there were more foreclosures so they could buy more homes cheap. And they're all now fighting with each other over a very much smaller supply.
I'm curious why you would include Pinal together with Maricopa County.
I think I include it because my study area is Greater Phoenix, and large chunks, in fact the majority of Pinal County is now part of Greater Phoenix. Okay. Particularly the areas around Santan Valley, Apache Junction, Florence, Casa Grande. These are all really just as close to Central Phoenix as, say, Buckeye is, and therefore I consider them as part of the market that I'm measuring. I can choose to exclude them. I can, all of these charts are easily recalculated if you were saying, well, what's it like if I just look at Maricopa? Or if I just look at Pinal for that matter. It doesn't make a hell of a lot of difference, however, but anyway, I do it. This chart shows the actual trustee sales, the completed foreclosures. And there are two colors here because there are two things that can happen when a foreclosure completes. There's an auction, but there may not be any bids. If there are no bids, the property goes back to the lender, called the beneficiary. And you'll notice back in this period, there was virtually no bids in 97, 98% of the situations. And therefore the lender got the home back and had to dispose of it. So back here, we were getting floods of bank-owned homes putting straight back onto the market when nobody really wanted to buy because everyone was scared the prices were going to get even lower. So the market just got worse and worse and worse. What we have now is a market where we've got fewer foreclosures happening anyway. This total is coming down. But relatively few of them are going back to the banks because we've got a lot of active bidding at the trustee sale. Anything half attractive is getting people buying it. Many cases in order to convert it into a rental. So you'll see, this is month to date, by the way. This is not the full month because that's October. But if we look at September, well over half of the homes did not go back to the bank. They went to somebody who stuck their hand up and bought it at the trustee sale. These are not generally normal homeowners because you have to have a $10,000 cashier's check and pay the rest in cash within 24 hours. So they tend to be either investors who've got lots of money in the bank or investors who are prepared to borrow at 16%. 16%? It's typically what a hard money lender will charge, something around that figure. It's actually quite common for example, somebody who specializes in doing fix and flips, they don't mind paying 16% because they're going to pay it back within 2 months. So to them it doesn't look like a big sum of money. But it's a way they can basically buy a home for maybe $75,000, sell it for $150,000, pay that loan back, and keep a pretty decent profit. It is a dangerous game, however, because if you fail to sell, the interest mounts up very quickly. And from the lender's point of view, it's pretty good because you're getting 16% or so, and you've got security, because the home is yours if they don't pay. You can foreclose. So you can see it's very different now from what it used to be. We had a very long period of stress. There are two periods where it dipped down. This is because of basically government intervention saying, hang on everybody, let's hold off and have a moratorium while we decide what to do. This was when Bank of America decided to hold off voluntarily for 6 weeks while it worked on the robo-signing scandal. And this is an artificial peak where Bank of America, again, for some reason, decided to do all of its foreclosures in 1 month. I don't know why, but they just decided to do a lot. And they also decided to open the bidding at a very high price and take those homes back instead of getting rid of them. Again, I'm not quite sure why, but you can see there were far more homes taken back that month. Next month they went back to normal again, so it's not necessarily that significant.
You mentioned flipping homes.
Yes.
I remember 2, 3, 4 weeks ago, there was some advertising to the general public.
Mm-hmm.
But how you can make money flipping homes, and it made it sound very easy.
You're right. It's not easy.
I wouldn't think so.
No. It is very profitable people who've got the formula right.
Mm-hmm.
You know, I know some people have been here for many, many years and they flipping as many as 100 homes a month. But they've got sort of an army of people who are skilled in particular things, who will be able to fix the appliances, do the painting, do the carpet at special rates. They know exactly what the value is that they can sell it for because they're so experienced. And it's become a machine for them, almost like a regular builder. In fact, we'd have even fewer tradespeople if it weren't for the fix and flippers keeping the plumbers employed. So there's probably about 900 or 1,000 homes a month handled by these people, and you tend to find it's the big boys who do it well.
Right.
The people who play at it often get burnt and end up selling the house for less than what they spent on it, and they don't do that again because it is quite risky. The biggest problem that the novice does is they overspend. You know, they try and make this house really attractive,
Mm-hmm.
and it's in an area where it's just, you know, it's never going to achieve the price they need.
Thank you.
Question.
Yes.
When you mentioned that the lenders are setting those prices very high at the auction, I've seen that a lot. Why? What's their thinking? Or what could be their thinking?
There's various ideas, but Bank of America be tight-lipped on why they did it. But you tend to find that the asset manager is trying to optimize the result for the bank. So if they think this particular home could sell better if it was properly marketed, they may decide to take the home back and spend the money on having a realtor sell it through the normal channels. Because when you sell it through a trustee sale, it's gone quickly and you get the cash, but you're probably getting a lowball bid. It may be 25% below market. So generally speaking, a bank will choose between the homes coming up for auction and pick a few of them to take in. It's unusual, however, that a bank like the Bank of America suddenly takes 80% of its foreclosures in, which is what they did in August. And none of the other banks are doing the same thing. Generally, the banks are trying to get out of the business of owning homes. And another thing they're doing is basically trying to avoid the foreclosure by allowing the owner to do a short sale, which, you know, 4 years ago there were very few successful short sales. Now we've got 3 times as many short sales as we have foreclosures because everybody's gotten much better at doing them. Particularly here, that's another thing that's different about Arizona, is that we have a legal situation where realtors can negotiate short sales on both sides, and they only get paid when there's a resolution, when it gets done. Otherwise they earn nothing. So there's a very strong incentive for them to find something that is happy for the current seller, the borrower, and the bank, and the new buyer. Some states you've got to have an attorney involved by law, and the attorneys aren't necessarily so motivated by getting the deal done. They just want to protect their client. So you end up with kind of a standoff situation when nothing gets resolved. So we have much higher success rates for short sales in Arizona, which of course is equally good at deleting and extinguishing a loan, which was delinquent. That's why our delinquencies are down so much. It's because we've got rid of so many of them by short sale and foreclosure. Yes?
On a short sale, can the lender come back to the buyer for
recourse?
forgiveness? Yeah, for recourse.
Generally speaking, that's an attorney question rather than a question for a back petition. But generally speaking, they don't in Arizona, because in most cases, it's not legally possible for them to come after you for the outstanding debt. And there are exceptions. It depends on what you use the loan for. For example, if you use the loan to go and buy an RV, then you're not really protected. But even then, some banks don't bother to go after you. They're just in a hurry to get this all behind them. So you can often negotiate and have them write into the short sale contract that they're going to forgive it and they're not going to come after you. Depends on the lender. But short sales are much more complicated. And it depends how many lenders there are, because there may be a first and a second, there may be a home equity line, but all sorts of things may be involved.
There are tax ramifications of that too.
You're absolutely right. Right now there aren't, but on January the 1st, unless Congress does something, we're going to go back to the situation as it was before 2008, whereas if you're forgiven debt, then you have to pay tax on the debt that's forgiven. At the moment, we've got a temporary measure in place that forgiven debt on a primary residence is not taxable. But nobody knows whether the Congress is going to do anything about that at the moment, so it's a big open question. I think the Senate actually voted yes on it, but it's not passed the House. And it's not. I actually saw John McCain, and he talked about this only a little while ago. He said he suspected the House would not get around to it. Okay, so the question that comes up a lot in this situation is one I actually heard on the radio being spoken. But what about all these homes that the banks are hiding? As you're probably aware, banks have not had a lot of good press in the last 5 years. And it seems to be that people will believe almost anything of them. Like they're partnered with Satan. It's really... And yet, banks, that most of the stuff they do is actually well documented. They're bankers, so they like to write stuff down. And anything they do in real estate has to be written down, because you can't own real estate unless you get your deed recorded. It's not a valid deed unless it's recorded. So, if you have a theory that the banks are holding on to homes, you can prove it or not by going into the county and actually counting up how many homes are deeded in their name or in one of their subsidiary names. So when I hear someone say something like this, my translation is that they're too lazy to check. Now, unfortunately, I have to do the checking. Somebody has to do it. And so I actually count them up. I use Excel. It's not that hard a job. There's only 5,000 or 6,000 of them. But I count them up every day. And I count them up over time. If you look at all the foreclosures that have happened, and here I'm just looking at Maricopa County, single family, this is what I counted. Reverted beneficiary, that means it went back to a lender, not necessarily a bank. It very often goes back to the government, if the government has guaranteed that loan. Nearly 140,000, huge number, have gone back. Another 39,000 have been bought by somebody bidding at the auction. So there's nearly 180,000 have been through the foreclosure process. That's a colossal number, because we only have 1 million homes in Maricopa. That's that's kind of 18%. And that does include the ones that did short sales. These are just true foreclosures. So you can imagine when you look at that number going back to the bank, people will say, well, I bet they're hiding a lot of those. But I also look at the MLS, and I see that they have sold 131,000 through the MLS. They also sold a few more, nearly 3,500, wholesale outside of the MLS. When they had so many, they were just willing to give them away. They gave them big discounts to certain people, but they didn't do a lot of that. And of the ones that are left over, 961 are still under contract and haven't been closed yet. They're just waiting for the title company to finish the stuff that they have to do. There are 992 of them still for sale on the MLS. You can still bid for them. Leaving only 3,000 unaccounted for. And these aren't really unaccounted for. They're the ones that got foreclosed last week and they haven't listed yet. There's no sort of secret store here. So this is why I say there is only 18 days of supply that's hidden away. And this number changes. It went up in August because of Bank of America's action, but it's going back down again now. Another way of looking at it is geographically. This is what the county of Maricopa created from the same sort of data for July. They counted, I said it was around 6,000, they counted 5,884 bank-owned or lender-owned homes, and they put a little dot on the chart for each one.
Does that mean on the market for July only?
These were owned by banks. They weren't necessarily on the market. Include ones that were on market, but it also includes ones that already sold, but were in escrow and haven't been closed yet. So this is just gives you a rough idea that they're everywhere. They're not really concentrated strongly in one quadrant. Generally, the lower priced areas have a slightly higher concentration. Here I'm now looking at pending foreclosures. So these don't belong to banks yet. They still belong to the owner, but they're under foreclosure. We've got about 16,000 of those as of July. And when you add them together, you've got nearly 21,000 distressed properties, which is starting to look like a lot. but it doesn't look like a lot when you compare it with March 2010, right? We had 63,000 then, so that was much worse. So it's not like we're back to normal, but we're nowhere near as bad as we were back in 2010, which was around the peak of the problem. So you can see it almost fully coloured in red over the West Phoenix, Glendale area. So because we've got less foreclosures going on, we've got less supply. And because prices are low by historic standards, most homeowners are not selling their home unless they have to or they really want to. Why would you sell when you're not going to get back what you paid for it? So supply is low. It is increasing, however. It's increasing because prices are going up, and that's how the market works. Prices will continue to go up until we get enough supply that we can get balance again. This shows you what's happening to the supply situation. This is taken from the MLS, includes all listings of homes that are available and not already under contract. The dark blue are normal listings, the light blue are short sales. These are REOs, which is what the banks called their foreclosed properties. And the little grey strip at the top are homes owned by HUD. Basically, the government have taken them back because they insured that loan, and the bank said, well, I've got it back, it's not my problem, FHA is your problem. At one stage, they were a reasonably large number, but they're now back to pretty small numbers. So you can see, first of all, that supply of homes for sale has come from 35,000 down to about 15,000. And you can see that we used to have more than half of the homes were distressed in one form or another. And now only about 20% of them are distressed, and that is, it's actually the normal listings that are growing rather than the distressed listings. This is everything on the MLS in Greater Phoenix. Slightly different picture if you start trimming it to particular segments. Here I'm looking at single family homes only, below 150,000. We used to have 20,000 homes available. We've now got about 44,000. So a huge reduction in what's available. Somewhat more than we had in the spring, but it is nowhere near enough to meet the demand. It's less than a month's supply. And we've got intense competition between investors who want to buy these homes to turn them into rentals, investors who want to flip them and turn them into profitable transactions, and generally first-time home buyers who are trying to get back on the, get into the home ownership game. Especially as interest rates are very low, and they can see, if I do it now, I can lock my interest rate in for 30 years, protect myself from inflation. Now, unfortunately, those people who need a loan to buy a home are generally losing out because the investors have got cash. And if you're selling one of these homes, generally you prefer to take a cash offer, even if it's slightly less than a financed offer, because it's more certain to go through. At the moment, the lenders are pretty strict in their underwriting. So unless you can come up with documentation that satisfies the underwriter that everything you put on the form is not only true, but completely documented, they're going to deny the loan. So you really have to go through a lot of hoops these days to get a loan, even if it's a pretty big down payment. Whereas, remember, 6-7 years ago, you just had to fog a mirror and you could get a loan, probably 105% of the value of the house too. So we've come to the opposite extreme of where we were. So what effect does that have on the market? Well, here's an example. This home was advertised starting April the 14th for $120,000. Fairly modern home in Glendale. Within a month, it had sold for well over the asking price, $140,000. That's not actually what's interesting about it. It's the fact he got 95 written off. Now, this is not unusual. It's probably the largest number I've managed to find, but there's something else, someone else out there who's got even more. I just haven't heard of it yet. 51 of those were from investors, and 38 were all cash. So there's a lot of money swishing about trying to buy these sort of homes. And indeed, 3 days after it closed, May the 14th, it was back on the MLS as a rental. And that's the story of our market right now. All of these owner-occupied homes are being sold and turned into rentals. Probably 10% of our housing stock has moved out of owner occupancy and into the hands of landlords. And the landlords have also started to change. It used to be small or medium-sized local people. Now increasingly it's multinational companies buying these homes by the hundred. And sometimes it's hard to tell who they are because they're operating with rather mysterious sounding LLCs with just initials. And you have to actually look at where the agent reports to and, yeah, that's the same office that this other company is in. So with a bit of sleuthing, you can find out who really owns it. For example, for a while, there's a company that came to town only in late April, and in the last 3 months has bought 500 homes every month. And it's THR Phoenix LLC. So I wonder who on earth these were. Eventually I tracked it down, and it's part of the Blackstone Group. They've already got 50 billion in real estate assets around the world, so they decided Phoenix Homes are also going to be part of their portfolio for a while. There are other companies like American Homes for Rent, American Residential Properties. There's about 10 of them in all that buy lots of homes right now, are building up a portfolio of homes, which they intend to keep for several years, intend to make decent cash-on-cash returns as landlords, and then they're banking on the fact that they will appreciate and be able to sell them at a significant profit on top of all the money they made as a landlord. So this is something that's really still reaching a peak. It's probably not going to get much higher than it is right now, but we're just coming to the crest of this wave. And that's part of the reason we've got such short supply, because we're creating all these rental homes and keeping ordinary buyers out of the market to a certain extent. If you go up market a bit, 150 to 500, you can see the supply situation is nowhere near as dire. It's come down, but it's not. It's only at half what it was before, and not 1/10 or 20%, and it's now growing. The higher pricing is bringing more listings out. As you go up market, 500 to a million, again, not as big a drop. We're also growing. We're about the same level as we were this time last year. So we don't actually have a housing shortage at the luxury home market. We don't have a glut either. This is kind of a nice balanced number. So prices are relatively stable in the luxury market. If you go up beyond a million, probably 900 to 1,000 homes sounds like a lot of $1 million homes. And it is, because that's probably as many as sell in a year. So it's a year's supply, but we have never had much less than a year's supply, even back in 2000, any time from there. There are always a lot of luxury homes for sale. Some of the people list their home even if they're not really serious about listing, just in case they get a decent offer. And these are often second homes, third homes, etc. They're not necessarily primary residences. But that market is nowhere near hot. It's kind of neutral. What has happened is the transaction mix has changed in what's selling. If you go back to August last year, we had a very large number of distressed sales, lender-owned or trustee sales, and a relatively small number of normal and new homes. These are the ones where pricing is sort of not like the normal market. So the more of those we have, the more pricing is like normal. 12 months later, we've got far fewer of these lender-owned and trustee sales. We've got about the same number of short sales and investor flips, but normal sales have almost doubled. And new home sales, still small, but 55% up. So these are the more expensive ones, these are cheap. So the transaction mix has been part of the reason our pricing has looked better. It's not because any particular home has gone up in value, it's because what you're measuring has moved. But prices are rising, even if you ignore that part of it, prices are rising, particularly at the bottom end. I like to measure in price per square foot rather than medians and averages. Tells a better story. And this is looking at everything in Greater Phoenix from the MLS. We were at about $90 a foot overall while the government was bribing us to buy homes. When they stopped bribing us, it took a bit of wind out of the market and we went all the way down to $80 and found a stable level there. We actually got to the absolute bottom summer last year, which was when the stock market also took a dive in the midst of the debt ceiling crisis and all the uncertainty around that. Once we got through the debt ceiling issue, prices started bouncing back, and then in the spring this year they really took off. We were going up at 5% per month, so fast that the appraisers were having a really hard time keeping up with it. And we had a huge war between realtors and appraisers, where the appraisers were undermining deals by not appraising the house for what the person wanted to pay for it. Which is okay if you pay in cash, you don't care. But if you're going to get a loan, the underwriter will definitely listen to what the appraiser says. And our appraisers are very wary of over-appraising because they got beaten up when they did it last time. Anyway, we reached a peak of 102, and then we went back a bit. Why did we go back a bit? Because it was the summer. That's the only reason. What happens in the summer is the luxury market goes really quiet. Because the people who can afford a luxury home generally can afford not to be in Phoenix during the summer. And they like to buy their home in the spring and get out. So that's why we peaked then, which is where the most luxury homes were being sold, and we went down in August, which is when the least luxury homes are getting sold. If you take out the luxury market, this is all smoothed out. But I'll give you the numbers the way they come out. Now it's getting cooler, we're going back up again. That's the whole market, but it's only a part of the history. If you look at that chart there, that's the bit that we just covered. When you go back to 2001, you can see the overall picture, and this looks like a relatively mediocre recovery compared with where we were. We got up to $190 a square foot at the peak of our insanity. And nobody wanted to take a presentation from me at that time. Because I was one of those people saying this will end in tears, it's a disaster, don't buy homes. So no realtor would let me near any of their clients. Now, we've overshot, because what pricing right now is about where it was in 2001. So those people who say the homes are now too expensive, they're not really being realistic. They are much more expensive than they were last year, but they've not even gone back to where we were 12 years ago. And if you insure these homes, the cost to rebuild them if they were burnt down by fire is higher than what you pay for them. Construction cost is more expensive. So where should prices be? Now, this is just an arbitrary long-term trend line based on the inflation rate. I just took the pricing as it was in February 2001, which was a fairly neutral period, and increased that with inflation. And the inflation for just about everything else would take us to about $130 a square foot for the Phoenix area. So we've got about halfway there from the bottom. I don't know when we're going to cross that line, but I'm pretty certain we will. It's just, is it going to be next year or 5 years or 10 years? Once we cross it, then we're into dangerous territory again, because we're probably going to come back down to that line at some point like we did then. But right now, the pricing pressure is all up. And unless we have a major change in the economy, it will continue to be up, but probably not at that rate, not 5% per month. That is really unusual. Much more likely to be more moderate. So these next three charts show you what it's like in different segments. Under 200,000, we've gone up 30, where all the action is really. Very low point. Builders can't make a profit at $57 a foot. I think that goes without saying. Even at 76, it's a bit of a problem, but it's an awful lot of profit if you can buy it at 57 and sell at 76. And some of the home builders actually turned their hand to buying foreclosures. So they couldn't sell any new homes, so they actually put their staff on doing what the big boys in finance do. A couple of the major home builders actually are now significant landlords around here. Between 200 and 500, you have to apply a little bit of sleight of hand here and look at a 3-month moving average instead of the 1-month moving average, because you get fewer sales, so there's more volatility. So in order to make the chart look a little bit easier to interpret, I take the 3-month average, and you can see we've moved up quite healthily from the bottom, which was around October last year, up 9% in 1 year. I mean, that's pretty impressive, given that that's about 3 times inflation at least. When you look at the pricing over 500,000, I take a 12-month average, because we get a huge amount of volatility in those home sales, and there are only handfuls of them a month. Even here we can see some slight increase, about 4% from the bottom, but nothing like as dramatic. I would call that, fairly stable and slightly positive. If we were to get significantly more demand, then this could start moving faster, because demand has been relatively weak in the luxury market for a while now. It's not like we're flooded with homes, and we certainly don't have lots of bank-owned homes on the market there. In the last 3 months, there hasn't been a single bank-owned home sold in Paradise Valley, for example. Whereas you go back this time last year, there were like 3 or 4 a month. So that sort of distress is drying up. This is my favorite chart, and I'll explain why. I licensed the data from the MLS. They don't let me share it with non-realtors. I'm allowed to make a presentation, but I'm allowed to give you the chart. The reason is this is measuring everything that's under contract, and that gives you a very good view of what's going to sell next month. So it gives you a chance to basically have a crystal ball, not long term, but at least 4 to 6 weeks out. So this showed us that we were starting to improve last summer, about a month earlier than the closing numbers did. It predicted that we would go down a bit in the summer, but it's been going up for a month longer than the sales numbers, and it's still headed upward. Actually, this was from the 15th. Today it's at $94.12. So each day I measure this. I know that sounds as crazy obsessive, but that's what I do. No apologies. I like to be the person who knows before anyone else does, because if it changes direction, I want to know and find out why. So this 30-day outlook allows me to tell you what prices will be next month, whereas what Case-Shiller tends to do is tell you what prices were 3 months ago. So I've got like a 4-month lead on the Case-Shiller index. Quick talk about new homes. They are now taking off. Demand is strong. You can imagine if you're a person who's put in lots of offers to be beaten out by investors, you're pretty fed up with being rejected, feeling very low, and you want a home before prices get completely outside your reach. One of the answers is go to a new home subdivision where they will take an order. They won't say, no, we can't sell you a home, or we're going to sell it to someone else. You might have to wait a week or 2 now, but at least you're dealing with someone who is nice to you and gives you a bottle of water. Seems to actually treat you like a customer, whereas if you're trying to buy a home from a homeowner and they've got 4 or 5 other offers at least, they don't treat you with any respect at all. So there's plenty of people going through the subdivisions trying to buy things. Specs are now at a 7-year low. Builders are trying to conserve lots, they don't want to run out. And we're actually got fewer subdivisions active than we had in January, which is quite scary, really. And of the ones we've got, 63% are due to sell out within 12 months. So we're in danger of getting very short of new homes to buy. If there was a major influx of people to Phoenix from other states, we would actually get seriously short of housing. And then the trouble is, most people just won't believe that. They're so used to hearing there's a glut of homes, the banks are hiding them, that they just think I'm crazy. But I could line them every single home builder and they say, Mike's telling the truth. We agree. It's exactly what we're seeing. And they're worried about several things. They're worried about running out of lots. They're trying to buy land and they're having a hard time because they're all competing with each other. And they're also finding that the people who have land are feeling, well, maybe I don't want to sell it. Maybe I want to hang on to it for a few years, because if it's as valuable as you're telling me, why would I sell now? I'll wait for it to peak. So there's a lot of people who very cannily bought home building land back in 2007 and 8 when it was really cheap. And they're saying, well, now it hasn't peaked yet, I don't think I'll sell it yet. So there's a shortage of land, there's a shortage of construction workers, but there's no shortage of buyers. And if you look at the sales rates for new homes, very bad month, January last year, only 267. That went to 424. Last month we got to 805, best month we've had for a long time. But even so, that's the same chart we just looked at, right? We were building more than 2,500 as long ago as 1999, when things were perfectly normal. So this is just peanuts. Not even up to 1,000. Now, I would argue that we're building far too many at this point. We're building them just for people to buy like they were just tradable assets, not to live in. But we've been building far too few for a long time now, so we do have a genuine shortage. Now, there's still plenty of people who will try and say, oh yeah, but we still have huge number of vacant homes, we have all this shadow inventory, and they'll wave their arms around and say, there's a glut out there somewhere, but I can't find it. And I spend all day, every day, counting homes and looking for it. I think we have a serious shortage. It's not really affected us too much because we've had a relatively low incoming population for the last 4 or 5 years. Nothing like the population growth we had between 2000 and 2005. But if people start coming back, if the economy improves, we're going to have a housing shortage. So my last chart, outlook, is that the low inventory will continue to cause prices to rise. And as prices rise, the inventory will start to grow. It needs to double from where it is now for it to be normal. We're about 15,000, 32,000 would be about normal for our inventory for Phoenix. And as prices go up, the investors will start to leave town. We've already had Colony give up. They came and bought quite a lot of homes in April and May, and they said, oh, it's getting too expensive, let's go and buy them in Atlanta or some other place. So they're still very active at other places, but they've decided Phoenix is too expensive now. Foreclosures are going to drop to normal levels probably within 12 months. Short sales are going to carry on for much longer because there's still a lot of people who are significantly underwater. The ones who bought a home in 2006, 2007, they paid altogether too much for their home and they borrowed an awful lot of money. And there's still a lot of people in those homes paying their mortgage on time. So if they want to move, they're going to still have to do a short sale. Builders are going to ramp up production, but they're still only growing slowly. We actually had fewer permits issued in August than in May. It's not, the permits aren't going up the way I'd like to see them, they're actually coming down. But if we can find a solution to the labour shortage, then we could start building homes faster. Okay, thank you for your attention.